The stock market is a marketplace where stocks or shares of publicly traded companies are bought and sold. When you buy a stock, you are essentially buying a small piece of ownership in that company. As the company grows and becomes more profitable, the value of your stock will increase, allowing you to sell it for a profit. This is one of the primary ways that individuals and institutions can generate wealth through the stock market. The stock market can also provide other benefits, such as: first, diversification. By investing in a variety of stocks, you can spread out your risk and not have all your eggs in one basket. This can help to mitigate the impact of any one company or sector performing poorly. Second, potential for higher returns. Historically, the stock market has provided higher returns than other investments, such as bonds or savings accounts. This is because stocks represent ownership in companies that can grow and generate more profits over time. Third, liquidity. Stocks can be bought and sold easily, providing flexibility in case you need to access your money quickly. It's important to note that investing in the stock market does come with some level of risk, as the value of stocks can fluctuate widely and unpredictably. However, over the long term, the stock market has historically provided positive returns. It's important to have a well-diversified portfolio and a long-term investment horizon when investing in the stock market in order to maximize potential returns while minimizing risk. The history of the stock market in India can be traced back to the late 18th century when the East India Company began trading in shares. However, the modern stock market in India began in 1875 with the formation of the Bombay Stock Exchange, BSE, which is one of the oldest stock exchanges in Asia. The first stock exchange in India, the Bombay Stock Exchange, BSE, was established in 1875. In the early days, the stock market in India was mainly used for raising capital for businesses, and the trading volume was low. It was only in the 1920s and 1930s that the stock market began to gain traction, with the establishment of more stock exchanges, such as the Calcutta Stock Exchange and the Madras Stock Exchange. After India's independence, in 1947, the stock market experienced a period of growth and expansion. The government nationalized several key industries, such as banking and insurance, which led to an increase in the number of publicly traded companies. In addition, the government also established the Securities and Exchange Board of India, SEBI, in 1992, which is the regulator for the securities market in India. In the 1990s, India began to liberalize its economy, which led to an increase in foreign investment and a boom in the stock market. The Sensex, which is the benchmark index for the BSE, reached a record high of 21,000 in the year 2008. However, the global financial crisis in 2008 to 2009 had a negative impact on the Indian stock market, and the Sensex fell to a low of 8,160 in March 2009. Since then, the Indian stock market has been recovering and has seen steady growth. The Sensex reached a new high of 63,583 in December of 2022. The Indian stock market has been attracting more and more foreign investors due to the country's strong economic growth and a large and growing consumer market. Overall, the stock market in India has a long and interesting history, marked by periods of growth and expansion, as well as periods of volatility and downturns. But in recent years, the market has been relatively stable, and it is expected to continue growing in the future. Thanks for watching our video. If you like our work, please subscribe to our channel and share the video with others.